Okay, so here's part two of our uses for beta and rho. So we've looked at how to use them to help build diversified portfolios, particularly rho, because we could do that mathematically fairly easily. But now we want to see how these things are used to understand the returns of an individual investment relative to its overall market. So something like, how's Tesla performing compared to the S&P 500? And we're going to do this mostly with alpha and beta. So for this analysis, we're pretty much going to be relying on alpha and beta. And that's going to come from a regression of the returns of the stock we're considering, which will be Y, versus the returns of the market. So we'll regress our stock to the market. Okay, so that's what we're going to be focused on here. We're looking at our stock and we're saying how's it compare to the market. So we're going to do this by, as usual, estimating historical returns of the market with some proxy, like the SPY ETF, which we've been using all along to measure the returns of the S&P 500 index. We've been using SPY because you can invest in SPY, you can buy shares of the SPY ETF, you cannot buy shares of the index per se. And then we get a list of historical returns for our prospective stock, whatever we want to compare to the market. And once we do that, then we perform a linear regression saying return of Y, our prospect, is equal to alpha plus beta times the return of the market. So this is the regression that we'll do. And then we wind up with a graph that looks something like this. So we have our prospective stock Y here, and we have the market down here. And you can see these are the historical returns that we've plotted. So when the market is here, the return of our stock is here, and we did that for all the historical returns that we had. And then the regression plots this best fit line, that's the red line there, and the slope, as always, is beta, and the intercept, which answers the question, how does our stock do on average when the market is returning zero? Our intercept alpha is here. So this is our regression line. Another line that folks tend to look at is what's called the market line here. And this is something you should know the definition of. The market line is just a regression of the stock market to itself. So it's a line on this graph with a 45-degree slope, and the intercept is equal to 0. So again, you should know what the market line is, regression of the market to the market. Okay, so now let's analyze this. So we've got our market line regression, and we've got our Y versus X regression, and let's see what we can say about them. So as far as the market line goes, we've got that 45-degree slope, beta equal 1, alpha equal 0. For our prospect to market regression, we're going to have two possibilities. We're going to have, as far as beta goes, we're going to have a slope that's less than 45 degrees, and that's going to correspond to a beta that is less than 1, right, because it's slope. And what that means, the interpretation of that is that our prospective stock is less volatile than the market. So beta less than 1 means we get this low slope, and it means that our stock, or whatever we're thinking of investing in, is less volatile than the market we're comparing it to. So that means it's got less volatility drag, it's less risky, and so it's probably okay for us as portfolio managers to accept it if it has a lower expected value. We'll see more about how portfolio managers make choices in a second. So if we do our regression and we get a beta we get a line that has a slope of more than 45 degrees, that means the slope beta is greater than 1. And our interpretation of that is that the prospective stock is more volatile than the market. And that, of course, means more volatility drag, more risk. And in that case, as a portfolio manager, we would want the stock to have a higher expected value. And we also want to think about, on this graph, we want to think about alpha, the intercept. And remember that alpha intercept is the return that we expect on average when the market return is equal to 0. And you pretty much always want to have an alpha that's greater than 0. Why? Because in that case, alpha is our excess return over the market. And you can see that very clearly on the graph. When the market isn't doing anything, it's just in the doldrums, we're getting this excess return. Okay, so now that we understand how all this works, how do investors use alpha and beta when they do perform these regressions? So essentially there are two types of investors. Folks that do this type of regression to help them decide what to invest in are either alpha-focused investors or beta-focused investors. Alpha-focused investors, they're looking for high alpha and low beta. And what that means is, I know you're thinking, some of you, I know you're thinking, wow, when the market's over here, if we have a low slope, you're not doing as well as the market. Yeah, but if you're over here in this whole zone, you're doing better than the market. And especially when things get negative, you're doing much better than the market. So our alpha-focused investors, they're looking for the high alpha, low beta investments. And the reason is they want something that's going to provide a consistent positive return. The key phrase here is irrespective of market performance, okay? And let me just go back to this. What if we had something like this? This would be the perfect thing for an alpha-focused investor here because they want something that's going to have a nice big return, not irrespective of what the market's doing. So maybe the market's doing fantastically, we don't care. We want our solid, nice big return. The market's doing horribly, we don't care. We want the same big, solid return. So that's what alpha-focused investors are all about. They want stuff that does well irrespective of market performance. Beta-focused investors, they're, by contrast, here's the key phrase here, they're all looking for performance relative to the market. So these are going to be mutual fund managers whose benchmark, quote unquote, is the S&P 500. The benchmark is what they measure themselves against. That's the market. So they care about how they're doing relative to their benchmark. They care about how they're doing relative to the market. So within beta-focused investors, there are two main classes. Beta-focused investors may want to have betas that are less than 1, and that's because they want stocks that are less risky than the market. So that would be another way to say that is less volatile than the market. Okay, and in that case, it's going to be okay to have a lower average annual return. They have lower volatility drag, and even despite that, they're going to say to the people who are buying their funds, well, yeah, maybe we're not going to have 12% average return, but when the market is down 10%, we hope to be down 5%. And that's very attractive to some people. On the other hand, the other big class of beta-focused investors are those that are looking for what we call high beta stocks. These are stocks with a beta greater than the markets, okay? And they understand these are riskier than the market, more volatile than the market. And to get investors to buy into their mutual fund, they're going to need a high average return. Otherwise, no one's going to be interested in their funds. They're going to say, well, I'd rather just invest in the market or a low beta type of fund. So let me just show you quickly that some different websites and things for alpha-focused investors and beta-focused investors. Here's a website called Seeking Alpha that is devoted ostensibly to all types of investment strategies that are alpha-focused. They want to do well irrespective of what's going on with the market. Okay, and if you just Google something like alpha-focused hedge funds, you'll find lots and lots of articles and resources on investors who are alpha-focused investors and want to do well irrespective of what's going on in the market. On the other hand, there are also tons and tons of websites and information sources on beta-focused investors. I've got a website here that includes a very large database of many ETFs, and they have a summary of the high beta ETFs that are available for sale in the US. They also have a list of low beta ETFs. So if you want to be that type of investor, if you want to benchmark yourself relative to the market, you could come to this website and look at some of the ETFs on this list. And if you wanted to be a beta-focused fund manager, you might also want to look at these to see what other people who are going to be your competition are doing. Okay, so back to our slides. One thing to note about this type of regression of stock versus the market, if we look at risk-free securities, i.e. something like treasuries, they're assumed to have a zero correlation to the market. So i.e. what that means is if we do a regression of treasuries to the market, we'd find a beta equal to 0. As always with things like this, it's not exactly true, but it's pretty true, it's close enough. So we usually assume that risk-free securities, typically as measured by treasuries, have a beta equal to 0 when we compare them to stock market returns. That's particularly, let me put in stock market there. Okay, so let's do an example now, thinking about alpha versus beta focused. Okay, so let's see what we got here. The mission of BlackRock's low vol stock fund is invest in a portfolio of stocks that have historically displayed less volatility than the market while moving directionally with it. So is this fund alpha focused or beta focused, and why? Okay, well, remember, alpha-focused funds want to do well irrespective of what the market is doing. So we've got here while moving directionally with the market, okay? And it's also specifically talking about volatility relative to the market, okay? So relative to the market, relative to the market. Alpha is all about not being relative to the market. Beta focused is always relative to the market. So this is going to be beta focused. So this is the type of question you should be able to answer with alpha versus beta focused. All right, let's look at another example. Let's compute rho, alpha, and beta to evaluate a stock in the way that a mutual fund manager would do. So first of all, let's see what type of mutual fund manager we're dealing with here. So the prospectus could say something like this: we build a portfolio of 30 stocks that behaves like the S&P 500 index. Okay, so this is clearly, again, going to be a beta-focused investor, right? Because they're referencing the market, they want it to behave like the market. Okay, so what's so special about this? Why don't we just buy the SPY? Because you can do this more cheaply with 30 stocks instead of having to go out there and buy 500 stocks all the time. So they might be able to do this with a very low expense ratio if they can pull it off, if they can get a good approximation of the S&P 500 with just 30 stocks. So that's what they're about, okay? And they're looking to see if Alexandria Real Estate's stock should be a good fit, should be included in this portfolio, see if it's a good fit for this portfolio. And they're going to look at correlation coefficient, alpha, and beta to help guide their analysis. So here's what they do. They go out and get historical returns for the SPY, which, as we know, is a very good proxy for the S&P 500. It does include having purchased all 500 of these stocks. And then we have the corresponding annual returns for ARE, Alexandria Real Estate. So this goes from 98 to 2018, and we have the average return for each one, the standard deviation for each one. Okay, so first thing we might want to do is say, okay, we've got this data. What's the correlation coefficient between these two? So we could do, if we were out there in the big bad real world, we could do this with Excel's Correl function, but we could also, in this class, and people do this with calculators all the time, we could use this formula and see if we can get it with that formula. Okay, and what we are missing here, because it didn't come through in what I pasted in, is the correlation coefficient on this page, but that's okay because we do have it calculated here. So we just got to look for it on this page. So now let's see if we can get the beta with this formula and go from there. So we're going to have 96.5% times, I just need these two standard deviations, which are back here where I was expecting them, 19.15%, 19.149%, let's use the whole thing, 49%. We want to have the ARE on the top here. So we've got ARE is going to be 20.384. So 20.384% divided by 19.149%. So let me go through with you why I got this. Here's my row, and this is times, and this is sigma. We want this for ARE, and we want that to be divided by sigma SPY, because we want our beta ARE to the S&P 500. Okay, so let's work that out. Okay, and we get 1.03 or 1.027. All right, so that's our beta. So we got the correlation coefficient from the Corel function, or we could have used horrific formulas we had before there for that. And then knowing the correlation coefficient and the standard deviations, we were able to compute our beta. And now let's look at this in the context of a linear regression. So I did go ahead with this data, and I got us, with all this data, I did do a linear regression of ARE to SPY in Excel, and this is what came out. So the regression equation is returns of ARE are going to equal alpha plus beta times the return of SPY. So the R square, this is our goodness of fit, right, is pretty good. That's high, 93%. So that would say, colloquially, we would say that about 93% of ARE's returns are attributable to the return of the overall market. They coincide with the return of the overall market. So we find in this case the intercept alpha is very small, again, and that's about 1%, and the slope is just about 45 degrees, 1.03, and we see that in our regression line. So as usual, the blue diamonds here are the actual observed historical returns of the SPY, which is on the x-axis here. And on the y-axis here, we have the returns of the ARE. And then the orange squares are the points that create the straight line for us. Okay, and again, we get that goodness of fit via R squared, which is high. All right, so what can we conclude about this? Definitely, ARE is highly correlated to the stock market. We saw that with the row. Remember, row can only go as high as 100%, so that's pretty good. And then we also saw that with our beta equals 1, which means it's pretty much moving identically with the S&P in terms of direction and magnitude. Because of that, especially beta, we say that it's got directionally same movement and similar volatility, so it fits very much our portfolio's investment mission. And an additional benefit of this for a portfolio manager, even though we are beta-focused managers, since we have that alpha of 1%, it's really true that we would say on average over the long haul, we expect ARE to produce about a 1% annual return in years where the S&P 500 is flat. That's good for you as a portfolio manager because that helps you not only be very correlated nicely directionally to the S&P 500, but to do better than the S&P 500 on average when the S&P 500 is just flat. So for all these reasons, we would definitely want to consider ARE for inclusion in our portfolio. Okay, last thing I want to talk about here is a real-world comparison of bills, and these are really treasury bills, bonds, and stocks over a long period. So I have a graph going back from 1926 all the way up to 2014, and what folks at places like Vanguard, who are very, very focused on having you invest in the stock market, will tell you is a diversified portfolio of stocks grows your wealth best over the long run. Okay, so we're starting with a $1 pile of money and we end up with almost 10,000. You can see on the trend here, this is growing much, much faster than average corporate bonds, which are this orange color, and the bills here, which are very close to inflation, not giving us that much. And that's true, except you have to be very wary of your investing time frame. So on the other hand, someone like the famous and very interesting economist John Maynard Keynes would say, in the long run, we're all dead. So what I've got here is a blow up of the portion of the stock graph. And this is, let me just quickly jump back here. We've got, this is the S&P 500 up here. So all of these are diversified. Okay, diversified set of bonds, and then inflation and T-bills follow each other very closely. So now I've got my blow up from 2000 to the Great Recession in 2009. So if you don't have a very long investment horizon, this could happen to you. You're up here, and then just a couple years later, you go down to 801, 1,500 and change on the S&P, down to 801. That's a minus 48% return. And now guess what? It's time for your kid to go to college and you literally can't afford it. Okay. Same thing happened here around. So this was actually with the dot-com boom, and then same thing happened around here with the Great Recession. If you start up here, you go down to 873, and you have a minus 43% return. So the message I'm trying to get across here is if you have a very long investment horizon, which most of you do as young folks just exiting college soon now, it is really true if you believe in the United States and other countries like it, that stocks, equity investments are going to do the best over the long haul. If you have a shorter investment horizon, you can't really afford to take these big downfalls. And you see there's a very big downfall here, of course, in the Great Depression. So stocks are great if you have a very long investment horizon. If you don't, you need something less volatile like bonds, and you should invest in those. Okay, and I think that is it. Thanks again for being with me, and I'll look forward to speaking to you again soon.